Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a housing advisory services company. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the third quarter of 2020. During the third quarter of this year, the unexpected housing market activity for new and existing home sales across the U.S. amid the COVID-19 pandemic and the monetary policy actions of the Federal Reserve in response to the current and anticipated economic environment across the U.S. amid the COVID-19 pandemic were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the third quarter of 2020. During the third quarter of this year, the unexpected U.S. housing market activity was the primary topic of discussion. As the bar chart below illustrates, new and existing home sales in the U.S. have proven to be counterintuitive to what most economists and financial experts thought would transpire in an economy disrupted by a pandemic. To explain, U.S. home sales have surged in recent months to the highest level in more than a decade. Many experts believe that the conundrum between the widespread lockdown of many business segments of the economy and the high national unemployment rate that is evidenced by more than 30 million people being out of a job, in conjunction with a relatively steady new home sales activity and a rebound in existing home sales activity, is a result of the COVID-19 pandemic having a much larger impact on lower-income Americans. Based upon research and analysis conducted by Atkins Capital Management, prospective homebuyers need to assess the following housing trends before deciding to purchase a home. The disproportionate impact of the COVID-19 pandemic on lower-income Americans will undoubtedly disrupt the rental housing market in the near future. This, in turn, may make renting a home a very attractive housing option from a financial perspective. Very high rental tenant eviction rates and significant financial strains on both the landlords managing rental properties and their financial lending institutions will transpire unless a national government bailout that is similar to what was put into place for small businesses is implemented. These events will likely make rental properties financially attractive to people looking for a place to live. A moratorium on rental housing evictions and financial bailouts for the lenders providing financial capital to rental properties will likely be required in order to maintain a stable society. While the cost of mortgage lending debt is at an all-time low, ACM does not believe that it is the driving force behind the new and existing home sales activity that has transpired during the pandemic. The 60 basis point interest rate reduction that has taken place over the last 12 months only saves borrowers about $100 per month on a $312,000 loan. This point is relevant because according to the St. Louis Federal Reserve, as of September 24th, 2020, the median new and existing home sales prices were $312,800 and $310,600, respectively. The Federal Reserve has stated that it will maintain accommodative monetary policy for the near future. This in turn means that the cost of mortgage debt will remain at a very low level, thus removing the pressure for people to rush in order to purchase a home. In view of the economic impact of the global COVID-19 pandemic, the Federal Reserve maintained a target range for the federal funds rate at 0% and 0.25%. The Federal Reserve expects that it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. The Federal Reserve also stated that it will increase its holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace, to sustain smooth market functioning and to help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. Going forward, it is logical to conclude that if the COVID-19 pandemic continues to curtail the U.S. economy, mortgage loan interest rates will continue to remain low, or even inch toward more all-time lows, in order to not impede housing market sales activity. In accordance with the monetary policy actions of the Federal Reserve, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 2.95% and ended the quarter at 3.09%. The previous all-time low of 3.31% was reached in November of 2012, and the all-time high of 18.63% was reached in October of 1981. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Atkins Residential Home Valuation Analyzer. Moving away from the impact of the COVID-19 pandemic on the residential housing industry and the monetary policy actions of the Federal Reserve on the U.S. mortgage lending environment, and instead focusing on an assessment of the price level of homes across the country, it is important to note that for the third quarter of this year, 21 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.09% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $116,115 and $251,384. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $315,736 and $526,018. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 39 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, Baltimore, St. Louis, and Indianapolis were classified as the top 5 most underpriced cities in the index. Although Detroit and Jackson had the same justified mortgage loan interest rate amount, Detroit was classified as the most underpriced city in the index based upon its justified percentage of household income amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.09% to more than the respective justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the cost of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective home buyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.